Welcome members and guests to the International Model Investment Club of the Better Investing Online chapter. On this page you're seeing right now, you can see links to visit our YouTube channel, our Facebook page, and our Better Investing page. We will post this meeting to YouTube, and there'll be links on Facebook as well. So here's some background on us. We were founded in May 2016. IMIC is a Better Investing Model Club open to the public. We have monthly meetings. We're held on the third Monday of each month. In December, we meet on the second Monday of the month. And we use hypothetical money. This is to avoid issues with currency exchanges and taxes. And our primary role is to be a learning lab to learn better investing principles and the fundamentals of stock investment using the online stock selection SSG stock selection guide, and to learn investment club operations management. All meetings are held online. We serve visitors, serving visitors and guests from around the world. We currently have 12 members in the United States, Canada, and China, so we're a national community. You can see on this pane on the right, well, here's some meeting conduct. The agenda is available in the handout section of the control panel. You can see that towards the bottom of your control panel. All visitors, guests will be muted during the meeting. They may post questions in the questions section. At the end of the stock presentations, visitors and guests will be unmuted and ask for their comments and questions. Meeting segments are timed, and we'll have a simple voice alerts when the segment is near the end and when finished. So expect those coming up soon. Here's our disclaimer. The information presented is for educational purposes only and is not intended as a recommendation to buy or sell securities mentioned. Views expressed are those of the participants only and do not necessarily represent those of Better Investing. Investors should conduct our research and analysis before making any investment decisions. Securities discussed may be held by presenters in their own portfolios. The presentations may contain images of websites, products, or services not endorsed by Better Investing or other presenters. The meetings are recorded and posted to our YouTube channel, as I said earlier. And so that concludes introductory materials. We'll move on to the agenda here, and you can see us again in the handout section of your control panel. We're doing the agenda review right now. We're going to do the Treasury Report pretty soon, and then we're going to have an education topic from Megumi on ESG investing. Then Hanny will do an education topic on the new AI, artificial intelligence tool, ChatGPT. This is for February right here. January 2023 stock review. Each will present with Hanny, Jane, Joelle, Isla, and Christopher are on the committee. And the free cash flow to net income will be done by Piero, another presentation. We'll have open mic for guest questions and comments, and then club business will conclude the meeting by 7:30. So with that, I will turn it over to Reddy for the Treasury Report. And let me change presenter if no one else is doing that. Okay. Reddy, do you see to be able to take it over?
You need to unmute yourself, Reddy. There you go. Unmute.
Okay.
Hi, Reddy.
Hi. I'll present this month's Treasury Report. It's not much action items to be included here. I deposited $1,300 as of today for 13 members. Only transaction we had last month was Qualys $2,000 buy decision, and this was the voting was passed on 21st December. So I took the 21st December prices, and it was 1805 shares for $2,000. I entered the transaction, and as of cash balance today, 3152, and we can buy some stock if we all decided today. Next one is the heat map. You can see that Qualys got where is the call is got a little bit bigger because of the purchase, and now they are showing a little bit more proportionally equal. There is no small square here as used to be. Our gains, loss, winners I listed here, just like the last couple months. Schwab and Vertex and Freeport McMoran are good winners as of this month, and Amazon, Algonquin Power, and Alphabet are the biggest losers. But I think in January things have turned around and things are improving. This will hopefully this will reduce losses in the next couple of months. The next slide is this shows overall current portfolio as of today. The prices are updated as of today, but the Qualis was purchased as of December 21st price. This is the full list of the stocks we have, and you can see a lot more red, but it is improving. You can see this slide because of only short month, 16 days. You can see that this month is looking good because our stock equities in our club are have gained, but the last year, one year data, we did much lower than compared to these indices. These are the sector maps. These are all the club assets we have. We have 12 stocks, and no sector is no pie is small. Algonquin is a little small. And Amazon is a little small. We can invest. I think Amazon is a good price now. We can invest some in Amazon and any other stocks that we are interested in. The company diversification wise, we have fairly good diversification. We can reduce the cash if we buy some stock today. We represent all the 4 major sectors, and this is the 11 sectors out of which we are still do not have any holdings in consumer discretionary, energy, and industrials, but we represented all other 8 sectors here. We can consider one stock in the sector that we don't have now. And this is the last slide. These are the industries breakdown of our stocks. Any questions? Any comments?
Thank you, Reddy. So should we go into the next person, John?
Yes, thank you, Reddy. And we'll move on to the education topics. Due to a miscommunication on my part, Megumi is not going to be presenting ESG investing tonight, but Hanny will present on the artificial intelligence tool ChatGPT. Hanny, we did start a little bit late, even though we don't have Megumi's topic, but I think about 20 minutes is all we can spare. I'll give you a reminder with 5 minutes left. Okay, little alert. So, but thank you.
Thank you.
Do you need to give?
I'll change it up here. Yep. Okay.
Is it showing anything?
Oh wow! Who owns that house?
Yeah, ChatGPT.
Okay, so I'm going to talk very quickly about ChatGPT. What is it? It's a GBT stands for Generative Pre-trained Transformer. It's a machine learning model that learns and generates human-like text. So you can ask it a question and get an answer. Unlike Google, where you put in a question and you get a bunch of web page links, this will actually give you an answer. ChatGPT was developed by a company called OpenAI, and it was trained on pretty much most of the data on the web, but up to 2021. So if you ask a question and you're looking for a more recent answer than 2021, you might not get it. Most likely you won't. It can learn patterns and structure of human language, and it can perform a number of natural language processing tasks, which are called NLPs. So it can translate documents, it can summarize text, books, articles, it can answer direct questions in sentence form, and it can actually write stories, poetry, songs, and it can even write computer code. Some examples, and these are examples that I actually, when I was playing around with this, I asked it. So I said, what is ChatGPT? And it gave me what that slide that I gave you. I changed it obviously, but that's where I got that information from. So I thought, okay, why would I do this? I'll just use the tool and see what happens. Again, it's like Google search, but you get real answers. I asked it, how will ChatGPT affect Microsoft and Google stock prices in the future? And it gave me a generic answer, which was not very intuitive. I asked it to suggest a list of mid-cap companies that will do well in a recession. It gave me a list of large-cap companies, and it's things like Coca-Cola, J&J, stable sort of Dow type companies. So I use Thinkorswim, which is by TD Ameritrade when I do any option or stock trading, which I do a little bit of on the side. And there's something called ThinkScript, which is a programming language. So if you want to search for certain companies, say you want to, do value investing on small and medium-sized companies. So rather than tell it what to look for, I just said, write a ThinkScript to identify quality small and medium-sized companies trading at a discount. And it gave me a number of criteria like, search for free cash flow. So it actually wrote the code. I took the code and I put it in Thinkorswim, and it gave me a bunch of companies. So I didn't have to identify the criteria; it did it for me. I asked it to summarize the book Flash Boys in 10 points or less by Michael Lewis about high frequency trading. It did that. And then I asked it to show me a low calorie recipe for dinner because I'm on a diet. So, and it did that as well. So pretty cool.
Wow.
Some of the limitations and issues, it needs a lot of data to function properly. It doesn't always give you the right answer because it's still learning. And then it's causing some concern for educators. Kids are using it to write essays. And I know one in particular, who shall remain nameless, who told me that they use it to write essays, and then they change what it gives them just to make it look like their own. But more concern was apparently one of the state medical licensing exams. ChatGPT was asked to write those exams, and it got a passing mark. So going forward, this is educators are pretty concerned about this. Because it's using data that's already existing, if there's any errors, biases, stereotypes, it's going to train on those things, and it'll just perpetuate them. And it's a standalone AI platform, so it's not connected to the internet. So new information is not taken into account. And it's difficult to use it right now because it's free and there's a large number of users. So sometimes when you go on it, you're not able to connect because the system is overloaded. So some interesting facts. It's developed by, as I said earlier, a company called OpenAI. In the first week that they released this, there were over 1 million users signed up. I don't know how many there are right now, but there's huge numbers. It learns from interactions with users. So the more people use it, it takes into account the answers that it's giving and what people are asking, and it actually improves itself based on use. So that's pretty unique and very powerful. It'll have a significant impact on programming and code development because, like I said, it'll actually, I asked it to write a formula in Excel to parse a string, and then I took what it came up with and I put it in Excel, and it actually parsed the string the way that I was expecting it to. So, but I know people use it for much more sort of sophisticated programming. There's still errors and so on, but it's cutting down on a lot of work. So this is going to have some very significant implications going forward for people that do coding. Microsoft is investing over $10 billion for a 49% stake in OpenAI. And Google has just issued an internal memo, code red, saying this thing is going to challenge their search engine, and they are working on their own AI enhancements for search. So this is going to, impact a lot of companies going forward. And by the way, this is a free software, but there are a number of companies right now that are using AI for all sorts of things. And a good example is in the medical field, where instead of doing all these drug trials, certain pharmaceutical companies are using the data that they already have about pre-existing trials that either went well or not, and they're feeding that into AI engines to try to focus new drug trials. And the list is endless. One thing that I was aware of early on was you could use this for in the legal field. So a lot of, in fact, I know I was working with a company in the UK, a law firm, and they did a lot of mergers and acquisitions, and they used an AI engine to review a document for a merger that they were working on. And it pretty much came up with the same conclusions that their lawyers came up with. So you could use this in the legal field quite easily. And the biggest thing, or the biggest potential I see is with Facebook, because Facebook has about 3 billion users, and they click on all sorts of stuff and they like all sorts of things and so on. So I think if Facebook was to implement some sort of AI engine using the just enormous data set that they have, they could, that would be huge, I think. So instead of spending all this money on the metaverse, I think that's what they should focus on. But I'm not Mark Zuckerberg. And it's ChatGPI is free for now, so I encourage you to go out and try it. And if you want to know where to go, chat.openai.com, and then just you sign up and get a username and password, and then you can start using it. And that's it. Thank you. Any questions?
I just have a comment. I have seen and heard poetry and art created by AI, OpenAI, and it's pretty impressive.
Yeah, there's also like another part of it where you could actually use it for pictures. So you tell it to say draw a picture of whatever.
Yeah.
and it does, and you could, draw a picture of the Mona Lisa walking on the moon or something. I don't know.
Yeah.
It'll do that sort of thing. So it's and that's also on. I think it's called Dali or Dala.
Dolly. Yeah.
Dolly. Yeah,
Dolly. There's
it's on.
different. There's a bunch of
It's on
different
their.
ones now.
It's Dolly's on the. It's also was developed by OpenAI, so it's on their website. So instead of going to ChatGPT, you can go out to Dolly and play around with the art. So it's pretty cool, but very scary as well. So all the stuff
It
that
is.
Elon Musk was talking about is, if these things are learning that fast, it's concerning.
Yeah.
Yeah, I know several people now that have mentioned it to me have been using ChatGPT in their actual workplace. That you were mentioning how people use it professionally, and between software engineers, marketing people, even lawyers, you're right. People really do use it. It's really interesting how you can kind of it's been described as like a personal assistant where you can bounce an idea and they come back with facts and opinions almost. So yeah,
Yeah,
it's really
and a lot
interesting
of
to see
a
how
lot
we
of companies are using like these engines, these artificial intelligence um, uh, engines to operate on their own data sets, on private data sets. So like I was saying, the drug companies, for example, or if you're one area that I know in engineering is if you're a large company and you have data on maintenance, you could actually predict when something will fail and do preventative maintenance before it fails. So people are taking all this, a lot of people have preventative maintenance or maintenance data that they've collected for decades, and they use it. Another one is in certain processes. If you're making something like in the steel industry, for example, you take raw ore plus scrap steel, you add oxygen and you add other things, and you come up with a recipe to make steel. Well, that steel has a lot of impurities sometimes and so on. But again, if you have production data and you know what went in and what came out, you can refine your process very easily and come up with something that's very high quality at a very low cost. So there's tons of sort of applications. This one is just is an open source, or it's not open source. It's free for people to try out, but the applications are endless, and people can use it on their private data sets.
That's a very nice presentation. I have a couple of questions.
Sure.
Microsoft is buying, and when it buys, it will have its own limitations from general user, and we do not know how it commercializes, right?
So they're not buying it outright. They're going to have a 49% stake in OpenAI, but it's a very convoluted deal, and people are still trying to figure out exactly because this thing uses like huge amounts of computing power. So it's sitting on Azure, from what I understand, and Microsoft is letting OpenAI have a certain amount of time on Azure. And that's like, I think $3 million a day or something like that they're spending on in the cloud. So yeah, there's going to be something, but you raise a good point. If as this stuff gets more and more sophisticated, and you can just imagine like people like in the defense industry, what they're using AI for. There's some pretty scary scenarios. But who owns this stuff, and is it how do you control it? And you can come up with all sorts of scary scenarios.
Yeah, controlling is one thing. Then they will start start charging fee for monthly basis, yearly basis, whatever. That's one thing. My next question is, I know this looks like based on a lot of artificial intelligence, but there are several other companies coming from artificial AI side, including Metaverse is based on AI. How this is different from other AIs approaches?
That I don't know, because I don't know what else is out there. This is more language processing. So like I was saying, it can do translations, it can summarize text, it can generate text, and so on and so forth. Some of the other stuff that I'm aware of is more specific for certain areas, certain technical applications and so on. But I am by no means an expert in this area. I'm just fascinated by it and just started sort of learning about it.
Yeah, my last question for now is, all AIs are based on statistical inferences. That means if they keep on collecting more and more data, statistics and predictions will improve. And did I hear you saying that this one, the data is all frozen now?
Yeah, so they train it on a data set. So the data set that they used was from the internet, a pretty wide spectrum, but up to I think 2021. I don't know how far back they went. And then when people use it, sometimes you get the wrong answer, and it'll come and ask you, did you like this answer? If you say no, it'll pop up and say, okay, how could we improve this? And so just by people sort of using it and getting the wrong answer and then putting in what they expected, the thing is learning through millions of people that are using this every day, and improving itself. So, but the data set is static right now. I don't know what the plans are, if they're going to expand the data set in the future. I'm sure they will.
Yeah, they have to be open and open to new data being fed. Okay, yeah. Thank you for clarifications. Yeah.
Okay, if there's no more questions, we have about 2 minutes left for questions, if there are any questions. But if there's no more questions, Mina, do you want to take over for the rest of the meeting with regard to the rest of the agenda, or? Okay.
Since you said you have 2 minutes, I have a question. No, this is a very good thing. I have been reading news on ChatGPT, Microsoft buying, and I do not know the details, but what are the chances of Microsoft being successful in buying this?
Well, they like, from what I understand, it's they won't buy it outright. Right now, apparently, and I don't know because I haven't seen the details, but apparently for $10 billion, they have something like 49%, and then over time, they will get their investment back, the 10 billion. And some of it is not just cash, it's giving them access to Azure, so they can put the thing on the cloud and they have a certain computational time. But one can only guess. I think Google has a monopoly on search right now, and Microsoft Bing is not that great. If they start adding something like this to it and improving it, then you're going to have two companies competing, and then if Facebook gets into the act, then so I don't know exactly what's going to happen, but I think all of these companies are probably looking at this stuff. And so from why did I choose this topic for an investment club? Because I think it's something to keep track of, because I think certain companies that we invest with right now, like you look at Google or Microsoft or what have you, they're all reaching kind of a equilibrium. They're not growing as fast and so on, and people are saying, well, have they reached a limit? And I think you're going to see new companies start coming out, and then some of these larger companies that have the resources will also participate, and this could be an opportunity for them to increase their revenues. So it's something to be very, to be cognizant of. It's reminds me like of the early days of the internet when everybody was trying to do something on the internet and take over the world. So this thing is, is like that. I think it's the next big thing.
Still not clear how Microsoft wants to make the money from their investment minority share.
Yeah,
that's interesting.
Okay, thank you, Hanny. That was very informative and it's very fun. I actually had it write a poem about this club, and it was pretty good. It generated it in 5 seconds, and I'll email that to everyone after the meeting. It's a pretty good poem, really. So
yeah, and you can tell it to like make it less choppy, or and it'll do it in seconds, and
yeah,
it's
very
amazing.
quick.
So I'm like worried about the creative world, humans in the creative, because it does a pretty good job all around. Anyway.
Right. So now I think we'll stick with Hanny because he was the lead for the January 2023 stock review. I know Anitra, our prospective member, will be doing some presentation, I think, but Hanny, why don't you go ahead and explain what you did and introduce whoever is going to be doing the presentation. So.
Okay. Let me. So can you see my screen or?
Yes, we see Amazon review.
Amazon review. Okay. So so we were supposed to do a stock study, and then we decided to review Amazon, one of our key holdings, and so we did that. The group that did most of this work were Anitra is a prospective new member, so she we had her do an SSG, and she'll be presenting that. And then we had Isla Barnes, Christopher, Piero, Jane Chen, who's not with us tonight, unfortunately, and then myself. And we also got some good advice and help from Ron Brun. And our methodology for this was Ron presented something called the 5321, which I had never heard of before. And we used that to analyze the third quarter 10Q for Amazon. And then Jay gave us Bakul Lala's financial ratios checklist. So we thought, okay, well that's new. Let's look at that as well and apply that. And then we reviewed sort of recent Amazon news and developments, and trying to see how those things would impact the operations going forward, whether it's revenue or earnings or efficiency and so on. And Piero will be talking about that a little bit. And then we updated the SSG, and Anitra did that, and she'll present that later on. So I'll just go through with the 5-3-2-1 methodology, and I'll go through our observations and then some of Ron's comments on this, on what we did. And this is a little bit backwards because we've already incorporated Ron's comments in here, so it's cheating a little bit. But we the first time we did this, it was not good, and he came up with some really good some advice, so we incorporated that. So all of these observations that I'm going to talk about are on the financial statements for the period ending September 30th, 22. So that's the third quarter of 22. So the idea is to look at the cash flow statement and look at 5 things on the cash flow statement that sort of catch your eye. And I think this methodology for me was a real real eye opener, because you know, sometimes you go through with through cash flow statement or financial statements in general, and you kind of, you know, your eyes blur. You don't really know how to look for or what to look for. So this was a really good way to focus and to be looking for specifics. So the first thing we noticed was that CapEx increased about 11% from 42.1 118. I won't read all these numbers, but I don't want to bore you, but CapEx increased by 11%. And then we noticed that money that was allocated for acquisitions went up quite a bit by 467%. And we know, one of the comments Ron made, and I've got his comments at the end, so I'm kind of meshing things here, but he said, do they grow through acquisition, or do they grow through internal investment? And when you look at the CapEx, it only increased by 11.7%, and then acquisitions by 467. But when you look at the actual numbers, they grow. They put a lot of money into CapEx, into their property, plant, and equipment. So they're growing sort of organically as opposed through acquisition. Even though there's a big jump from one year to the other, most of the cash is spent on internal improvements. And as a result, their cash flow margin for this period was down 50%. Net cash from operations was down 27%. And then stock-based compensation went up quite a bit, like 50% or so. But again, Ron said, well, where's that sort of coming from? Did they buy back any shares? And sure enough, when you look at shares, they purchased about $6 billion worth of shares. And so their net impact, instead of being 14,105, if you subtract out that 6, it's about 8 billion. So that was another thing which, I wouldn't have noticed that without going through this exercise. So I think it's very useful. Then the next thing is to look at the balance sheet and make 3 observations there. And we noticed that debt went up by 21%. Goodwill went up by 33%, and property, plant, and equipment represent 41% of total assets. So again, this was a Ron question. Are they growing by acquisition or by putting money into their infrastructure? And definitely 41% of this property, plant, and equipment represents their assets. When I went through this thing, it was very, I thought it was just an excellent tool. On the income statement, we had to make 2 observations, and operating income was down by 50% for the quarter, and that impacted earnings per share. They were down 148% from $1.85 in the same period in 2021 to negative 89 cents per share. And then once you go through this, you're supposed to make 1 reflection, and I couldn't really fit it all. So, and Ron is going to probably say, well, there's 5 things here, not 1. This is a very long sentence. I just broke it up so that I don't have to read a big long sentence, which is an excuse for I couldn't really find 1 thing to focus on. But overall, not a good quarter for Amazon. Costs are up, cash flow is down, net earnings 89 cents a share. That should be 89 cents, not $89. And they increased their Prime membership fees from $139 a year to 109, from the 119, sorry, to 139 per year. And this is in the US. I think in Canada we're still paying whatever it is. And that's, I think, to fund AWS, their fulfillment and delivery. And then 2022 is very challenging. The stock price took a big hit, but there are some positives, and I think Piero's going to talk about those. So our final note is just keep a close eye on the 4th quarter financials and see if things improve now. One thing I want to say is Jane Chen was, I had gone through these, and she came back and checked all my numbers, and she had some really good insights that I didn't catch on to, but I expect that from Jane because that was her profession for a number of years. So we're kind of very fortunate to have somebody like that in the club. So these are some of Ron's comments. He said, look at the cash flow statement. Is the company getting stronger? Are shareholders benefiting? How are they spending on plant and equipment. What's the ratio, which I talked about, ratio PP&E to assets? Is it trending up or down? Are they growing through acquisition? So these are all kind of related. Is it a capital intensive business? And we'll look at some of this in the ratios that we're going to show. And then shares outstanding, again, he was kind of looking at the when we said there was dilution going on, he said, well, did they buy back any shares? So that was pretty astute. I didn't really think of looking at that. So obviously he's done this before, or he's cheating, I don't know. Then we went to Bakul's financial ratio checklist, and again, that was very useful tool, because it gives you sort of a structure and a process to follow. So what we're going to do here is I'll just describe. These are the 10 ratios that we looked at, and these are in order of the people that'll be presenting. And what we did was we put all these ratios in a spreadsheet, and which I will now, I think, that's the end of that. So I'm going to bring up the spreadsheet, and then we'll go through the ratios very quickly. Just give me 1 second here. I've got it, and let's put it up here. Okay, I hope people can see that. So the first one is capex to sales. Sorry, any questions, first of all, on the 5321?
What's goodwill?
Sorry?
You had there was a goodwill. What does that mean? It was up like 33%.
Oh, okay, sorry. Yeah, goodwill is when you buy a company, and Amazon is they've acquired a lot of sort of small tuck-in acquisitions. But when you acquire a company, say you acquire an architectural firm, something that you might know something about, and so the partners in the firm might say, well, okay, if our value is X, but we have all these relationships with these large clients, and these are going to bring you, business in the future. So you can't just look at, say, our revenues today and make a determination of price. There's a lot of goodwill because of our name and our reputation and our relationship with these clients. So the goodwill is that portion of it. And if you're fortunate and you do the acquisition and everything pans out, then you might, it might pan out. But a lot of times people overpay for acquisitions, and it's the goodwill portion. And whatever the goodwill is, whether it's clients or relationships or what have you, sometimes it doesn't materialize, and so you have to write the goodwill down, write it off. So their goodwill went up, but it went up by a lot, it looks like, but that was probably, it's a small acquisition that they made. So in the overall scheme of things, it's not a big deal, but it just shows that there was some component of goodwill in whatever acquisition they made.
Okay, thanks.
That's a very good question, very general question. Thank you, Hani. Very good presentation. I have one question. This cash flow, okay, I'm not a financial major. This cash flow, we have to pay more attention when the company is kind of transition or going downwards, right? But Amazon is still in a good status. Is this a topic very important for companies like Amazon?
Yeah, that's a good question. I think so. It's the issue that you might get an answer to that already in when we look at these ratios. I think Piero is going to talk about the cash flow, I think. So one quarter doesn't make a company or the year. So you have to look at the trend. So you're absolutely right. If you look at the trend, the cash flow is going up. But I think if you look at the recent stock price, it's dropped quite a bit, and that reduced cash flow could be maybe one of the reasons. There's probably a lot of other reasons like revaluation and because interest rates have gone up and so on. So there's probably other factors of why it went down, but that the cash flow, if you're an analyst and looking at that might be one reason.
Yeah, well, the whole market is down 20 to 30%.
Yeah.
The cash flow is, I'm not sure is causing the problem, but yeah.
No, but it's just an observation. But you're right. Like it's probably not a major contributor. You have to look at the trend.
Yeah.
I don't know if Ron is on, but if you're on, if you wanna jump in, feel free. So
He's self-muted.
okay.
Yeah, I'll discuss it at the end. Let them go through the whole
Okay.
presentation,
Okay.
and they might be able to find their answer then.
Hanny, should I hold my question about how you came up with the 5321?
How did we come up with it?
Yeah, well, first of all, that, sequence, and then within that sequence, is it subjective?
Well, the sequence was Ron's. He told.
Oh, that's Ron. Okay.
Yeah, Ron
can
can tell you why. Yes.
But as far as like which things did we pick within the 5, 3, and 2 and so on, it was pretty random. We just kind of looked at the at each statement, and then things that catch your eye, and this is where I think this tool is really valuable, because you look at certain things and you say, okay, there's not a big deal here, there's not a big change or whatever, but then you notice something else has changed quite a bit, and that gets you asking more questions. So there wasn't a methodology. Maybe there should be, I don't know. Maybe Ron can tell us that later, but we just kind of, everybody jumped in, and everyone said, oh, look at this, look at that, and then we kind of distilled it into 5 points.
I do attend a few other clubs, and I hear Ron Brain's presentations. Very nice, very good. But the thing is, when I hear about cash flow problems, I thought it is only for companies which are in trouble that we had to pay more attention.
We didn't say there was a problem. We just said it decreased.
Okay.
There's about 15 minutes left for this presentation, so if you want to.
But before we get going, we do have a question. Can you explain CapEx before you get into this ratios?
Sure. It's capital expenditures, so money that's spent on property, plant, and equipment. So it's capital expenditures. So for this ratio, I was supposed to look at CapEx divided by sales, and so how much are they investing out of their sales into CapEx? So you take the revenue or sales, and then the CapEx is a line item that in the financial statements, and you divide one by the other. So I got about all these greens. It's the for online retail, and Amazon is very difficult in this case, because you don't know who are the peers. But for online retail, so that would be Walmart, Best Buy, and so on, the average is about 8.3. And for internet software, which could be classified as that, it's about 11.3. The 5-year average is 8%, and it's less kind of than that, so it's not too much. There's the last couple of years, because of the pandemic and the amount of investment they made in their warehouses and delivery and so on. And then one other one, which is CapEx divided by depreciation. So if you depreciate something and your CapEx divided by depreciation is 1, then you're kind of replacing what was depreciated. And if it's less, so these red ones here are, there's less CapEx in that particular year than what is being depreciated. So maybe you're not replacing your equipment. So again, the S&P 500 average is 1.4. Utilities and energy companies are very capital intensive, and they're about 1.8 to 2.1. And the 5-year average for Amazon is 1.2. So that's not bad. So next, Isla is going to talk about the margin ratios. So I'll hand it over to Isla.
Oh,
Okay, can everybody hear me?
Yes.
So good evening, everybody. So I'm going to talk about 3 basic margins. Now, what margins tell you is once you have an amount of money that you've made in revenue, how much is left after you subtract certain things. The first margin is the gross profit margin, and that is after you've made all your money, there are certain direct costs that you have to incur to produce the goods or services that you're selling. What are those, how much of those direct costs are costing you, and how much is left over after you pay those direct costs? In Amazon's case, over the years, over the last 10 years, their gross profit margin has risen. It's gotten higher, meaning that while they're making more money, and they are, in fact, spending more money on cost of revenues, the percentage of the cost of revenues gets smaller. So the amount of money that they have left over gets larger. So gross profit is something we can measure with any company at all. Once you get past the gross profit margin and the gross profit number, then you want to know about operating margin. So operating margin also incurs some other costs, such as in Amazon's case, fulfillment, technology, sales and marketing, and general and administrative expenses. These are not things that they say are directly related to providing the goods and services that they do, but they are sort of the ancillary services. So once you get past the gross profit, when you take all of those items out, then you're left with what is called the operating income. You take the operating income and you divide that by the revenue that you have, and that will tell you how much you're left with. And hopefully, the operating margin, according to Mr. Bakul Lala's financial ratios, the operating margin should be around 15% for most companies, not for every company and not for every industry, but for in general, about 15%. As you can see with Amazon's operating margin over the last several years, it's quite a bit below 15%, but it's a very, very large company. And they do have a lot of expenses. So it's probably not horrible that they're under 15%. And that, in fact, it's possible that they may never ever get to 15% because they are so large already. The next part is to, once you get to the operating income, you want to look at what the net income is, and that means that you're going to start, you can add back interest income if your company happens to have that. You can subtract interest expenses. If you have any other kinds of interest income or expenses that you might not want to call out specifically, just lump them in the other category, that would go in there also. And then also taxes are included in that. And once you subtract or add all of those, you end up with what is called the net income. You take the net income and you divide that by your total revenues or total sales. And that tells you how much you have left over for dividing by the number of shares, and you will end up with your earnings per share. So as you can also see, within the first 3 years listed here, 2012 and 2014, there was a negative net margin. But thereafter, the net margin started to go up. And again, most of their margins are trending up over the course of the 10 years that we're looking at here. They may not meet the guidelines that Mr. Lala set out. The guidelines for net margin would be approximately 10%. They're not meeting the guidelines, but they are going up over the 10 years. Any questions?
Okay.
interesting presentation, Ila. Okay, by all your definitions of 70%, 20%, 15%, Amazon never made it, not even halfway through. How do we justify? How do we justify? And I still believe Amazon is a good stock.
Oh, I believe that Amazon is a good stock also. I think that the guidelines that Mr. Lally used are kind of very general for the market in general. And I don't think they're specific to certain industries. If we look at the gross profit margin, his guidelines say that your gross profit margin should be over 50%. But I think most of us know that almost no company regularly gets a gross profit margin of 50%. There may be some newer tech companies early in their existence that get 50%, or over time, your costs and expenses will eat that down. It will come down a little bit.
So
And
one other
go ahead.
thing, which I think we discussed in the study group. So if you, I'll just go back here. There's a link here to New York University Stern School of Management, and if you go there, you will see a lot of these ratios that we're going to talk about today. They're broken down by sector, and so I think these guidelines where it says 50 and 15 and so on, you have to compare it to the peers, and you have to compare it to the sector. And Isla did that actually with, was it Microsoft and
Alphabet.
Google? Alphabet. You know, but Amazon is into all sorts of things, so it's really difficult to compare it to, you know, one thing or another. But it's a lot easier, say, if you're comparing, you know, oil and gas companies to each other or something like that. So,
yeah, it is much easier if your companies pretty much are in the same business 100% of the time. But Amazon is not in the same business as anybody else 100% of the time. You can compare parts of Microsoft and Amazon because they both have cloud businesses. So it's the same with Alphabet. But Microsoft has some hardware that they sell, but they don't sell nearly the number of things that Amazon sells, and Google the same. So there's always a disconnect there. I know it doesn't show here, but generally speaking, the gross profit margins, the operating margins, and the net margins for Amazon and Alphabet far outstrip Amazon, far outstrip them.
I think, yeah, I think he partially answered my question. These margins.
Betty, can I interrupt for a second? We only have 6 more minutes left for this 30-minute presentation, Hanny. Is there?
yes. So Piero, Jane, Chris, Anitra are still to present. Sorry.
So in the interest of time, I think let's hold questions and let people get through their presentations, and then we can ask questions at the end. How does that sound?
Okay, I will not ask any more questions until the end.
Okay, I'm done.
Thank you, Isla.
Okay,
Thank
so
you.
Chris is going to do Jane and Chris. Because Jane's not here, so Chris, go ahead.
Yeah, so here's Amazon's return on assets and free cash flow to sales ratio. So return on assets is calculated using net income over total assets, and we can and it's used to determine how efficiently a company uses its assets to generate a profit. But we can see here that Amazon's ROA is often not, it's often like below 8%, which is like what was defined as like a good ROA. And specifically, like, it even incurred a significant marketable equity securities validation loss of 11,000 million in 2022, which is a loss of 3,000 million for the first 9 months of 2022, so this past year. So we can see here that like sometimes the ratios are even negative, which is something that we might be worried about. Yeah, and then free cash flow to sales ratio. So free cash flow to sales ratio is basically so I mean, as it said, right, it's free cash flow divided by sales. And we can see here that because Amazon has been investing a lot in its capital assets, they don't have that much free cash flow. So that's why the ratio is pretty low, just because like they're using the money to reinvest. And yeah, and it's sometimes it's not enough to cover their capital investments. And yeah, and I can go ahead to cover my financial leverage. Yeah, so here we can take a look at the financial leverage as well as the debt to equity ratio. So yeah, so high leverage is a potential risk because if it's unable to generate a higher return, a rate of return than like the loan that I took out, right, than the interest rate on the loan, then they'll be effectively like not making money, right? So this is the case for Amazon because like they're a serial acquirer. They like acquired Whole Foods and then also like a lot of other companies like Twitch prior. So they like their sales is not actually able to like finance all this acquiring. So they take out a lot of debt, and we can see this in their debt to capital ratio, which is a 5-year average of 53%, and also in terms of like their total, also in terms of their financial leverage, which is 3.7 over the past 5 years. And financial leverage, I guess the equity multiplier, if it's lower than 2, it's a good leverage ratio, and yeah, it's 3.7, which is pretty high, which seems to indicate that they just have a lot of debt compared to their shareholders' equity. And yeah, I'll hand it off to the next person.
Okay, we'll do Anitra and then Piero because he's got a separate presentation.
Okay, it's for me.
Yes.
You said Anitra? Okay.
Yep.
She's self-muted.
Amazon's return on equity and the ROIC, which is the return on invested capital. Over the last 10 years, Amazon's they're on the return on equity has gone up regularly. It's gone up regularly, however, it has it's actually made some changes. It's not flowing very smoothly. For the return on equity, we're looking for the management's job to make money and show how well they'll use it, how much profit the company will generate on the amount of money that the shareholders has invested. It shows the return of assets on times that's financial leverage. So it's gone up for the first 4 years, and then, first 5 years, and then it went down, but then it's been fluctuating. So it's not 100%, yet it's still better than, it's in a good place. It is above the 20%, which is great. Same on return on invested capital. It has been fluctuating, mostly going up, and then it dropped. It actually when it is at 12% in 2021, end of 2021, which again is above the better, but it's looking for that it's doing great. It's really in a great place. The formula is the ROIC over the NOPAT, which is the net operating profit after tax, divided by the invested capital, and that would give you your ROIC. And the same with the return on equity. It's the net income over the divided by the shareholders' equity. And that's it on that.
Okay, Piero, do you want to bring up your presentation that you did? Oh.
Shall I hold on?
Yes, we've got one more ready. Piero? I think he's self-muted.
Muted. Muted.
Piero, you're self-muted. Okay. Should we open it up for questions till Piero presents?
Sure.
Okay. We did have a question. Do you show cash flow for 10 years in any charts?
Yes.
What do you mean, any charts?
It's in Morningstar. The financial ratio has the cash flow for the last 10 years.
Hello?
Piero?
Yeah, yeah.
Okay, go ahead, Piero.
Okay, so anyway, I was talking about free cash flow to net income, just the ratio. And so I did a little presentation. I was kind of misunderstood what to do. But anyway, on the income statement, that's where we find the net income, right? Now, I should talk about a little bit about the income statement. The income statement uses accrual accounting, which allows the company to recognize and record income before they actually receive any money. It also allows them to record and recognize expenses before they pay any money. That's just the way accrual accounting works. So because they have to do this, they're really making a best guess estimate. And because they're guessing, it's open to manipulation. That's the income statement. Now, the income statement ends with the net income, right? So that's the first statement you should look at for net income. Then the cash flow statement, they use a different type of accounting called cash accounting. And they're very narrowly focused. They want to know about money, how much money came into the business and how much money went out of the business. That's what they're focused on. And you find that on the cash flow statement, right? So what cash flow statement usually begins with is the net income from the income statement. That's the first entry. And then after that, they pardon me? Okay, after that, after the net income on the cash flow statement, they add and subtract cash, non-cash transactions back to the net income. So the net income is not going to be exactly the same as it was outlined in the income statement. Okay, once they've done all that, then you look at cash from operations. And then when you got cash from operations, you subtract capital expenditure. And as Haney pointed out, that's essentially property, plant, and equipment, the money that you spent. So by definition, subtract cash from operations minus capital expenditure is equal to free cash flow. All right. So in the short term, net income and free cash flow are going to be different, but over the long term, they tend to come out to be similar. They should be similar. Now, ideally, you want to buy a company that regularly converts some of their net income into free cash flow, because free cash flow means money above and beyond their expenses. And you could take that money and throw it back into the company to expand property, plant, equipment. You can do other things with it. You could reduce debt. You can purchase back shares. You can issue a dividend. You could issue a special dividend, anything like that. Okay, and next is that, as I was kind of alluding to, is that net income is really an accounting number. Okay, and it's a best guess estimate. Whereas the free cash flow is more narrowly focused. It's focused on money. So when you have kind of questions and doubt, look towards the money, the solid, hard fact, right? Look to the cash flow statement. But it's important to keep an eye on both things, because over a period of time, you'll see the tendency, you'll see the trend. And I have what's it called, a quick little summary here of the Morningstar key ratios. For free cash flow over net income is going down, down, down. So in the last couple of years, it's been actually negative. And that means that they're spending more capital expenditure than they're taking net income, than they're bringing in. They're spending more. And why they're doing that is because that's one of the problems that Amazon has had. They're building out their infrastructure. During the time that they were, everybody was shut down, everybody was going on the Amazon to buy stuff. So Amazon said, oh, wow, this is great, wonderful. We can expand our fulfillment centers. We can expand our internet centers. They just built. So they spent more money than they actually took in. So cash flow to net income is down, negative. And I should say that when you convert your net income to a portion of cash flow, free cash flow, It's called the conversion factor. And as Belial was saying, that the conversion number should be around 1. Should be steady, and it should be growing, preferably. Another little thing I just for the sake of education, the free cash flow statement, it has, because they're reconciling cash and non-cash items on the income statement, they, this is from Morningstar, they have a whole bunch of subcategories and all this kind of stuff, and it's kind of confusing. The only thing that you really have to look at is here, cash from operations, and then just jump down to purchase property, plant, and equipment. Subtract the 2 numbers, and that gives you the free cash flow. And here they spent, as in the case of Amazon, they spent $61 billion, but they only took in $46 billion. So they're in a net negative cash flow situation. And then on the income statement, they have a whole bunch of other things too, and it's kind of confusing as well. The only thing you really need is to look here, net income available to common shareholders. That's it. Just do that and you should be okay. Any questions?
Well, we should probably go to, is it Anitra, Henny, that goes next?
Yep. I think
Henny or Anitra, do you present an SSG now? Is that what we're doing? Or?
Yes, I'm presenting the SSG.
Sorry,
Okay,
yes,
great.
I was muted there. Yeah, Anitra is going to do the Amazon SSG. We've updated it.
Great. And there should be some kind of dialog box to accept the presentation controls, and we'll see your screen at that point. Okay.
Okay, let's see. Do you see it yet? No.
No, we don't see it yet. There's probably some kind of.
I think I'm still holding the screen, right? Do I give it up? How do I give it up?
No, Anitra, waiting for Anitra to accept sharing.
Oh, okay.
Probably hidden in behind your screen or something.
It's making me reload.
Okay, I'm putting it back. I'm putting it back too, Anitra. I just wanted it to show up again.
Okay, there we go. It's asking me to restart or quit GoToWebinar, so I'm going to restart it.
Wait, no, don't do that.
No.
What we can do, I can bring up, or whoever is showing, I can bring up the Amazon SSG, and we can just do it like real time.
Thank you, Henny. Yes. How about make you presenter, Henny? So Anitra, you can look Henny's screen and just walk through, talk about it.
Okay. Anitra, can you see it?
She did the log off. I don't know why.
Oh, all right.
Oh gosh, the graph doesn't look good at all, except the sales.
Yeah, free cash flow dropped like a rock, as we were saying, and then.
Oh yeah, now look a little bit cleaner.
So I'll just I think between all of us that were on it, I think we can.
Oh, I need to bring her back too as a panelist. Hold on.
Yeah, she's back.
Oh, okay.
Okay.
Yep.
Okay. Can you see my screen?
We need to make you a presenter. Just a second. Okay. There you go. Yep.
Okay, let's see where it went. All right. Okay, so the stock selection guide on Amazon. Amazon is a large company. It's a consumer cyclical, and it's a leading online retailer and the highest grossing e-commerce aggregators with 386 billion in net sales and approximately 578 billion in estimated physical and
Yeah,
digital online gross merchandise. Okay, you don't need that part?
we
Okay.
know. I think all of us know, right? We all shop at
Yes,
Amazon,
it's
supposedly.
going okay. As far as the sales, it's going up, but not straight up in parallel, but it is moving up some. It has
So
Anitra, yes.
Anitra, you might want to just explain, because you have all of the various years locked out. So you might want to
Outliers, okay.
yeah, why did we do that?
Okay, so we blocked out all the up from 2012 to 2019, 8 years, because of the fact that pretty much there's been so much changes in Amazon, and in the past that the growth of Amazon today is so much different than those years and than the previous years. So we kept 2020, 2021, and
We were trying to sort of see what the most recent growth is, because it was growing at 26% if you include 2012 to the present. So we thought that was a bit too aggressive. It wouldn't grow at that rate, and we're just trying to see more recently what would the last couple of years.
That's a very good question, Haney. That's a very good question. SSG is not meant for typical companies like this one, okay, and you're discarding 9 years of data and keeping only 1 or 2 years. Okay, does not indicate the real trend of the company, which has been there in the business for a long time.
Well, if you undo all those red years, you're going to get a growth rate of 26% in sales. So we were thinking that, you know, a company this large is not going to grow at 26% going forward. So taking the last few years, just looking at that, so the law of large numbers. So it's probably going to grow at something a little bit less. That was the rationale for it. And if you look at the sales estimate from the analysts, it's at 9%. I think based on discussions that we had as a group, we came up with 8.5. If anybody else in the group wants to jump in, you know.
Any all the negative numbers have to be blocked because logarithms do not have a meaning for that.
When you say the negative,
all negative numbers have to be blocked.
Yeah, but
right, but there's no negative numbers except for pre-tax profit.
2014 has EPS negative.
Sorry?
Well, they're blocked now, so let's just let Anitra do her presentation, I would say.
Yeah, 2014 has the only one number negative I saw.
Yeah. No, we're just looking at sales right now already. We're not looking at the other.
Okay.
Yeah, we're just looking at sales and EPS.
So with the forecast of sales, we don't think that it's going to grow as much as it did over the pandemic. People are going back to work, going back into stores, and they are having many other options of e-commerce, as well as the fact that they're doing in-person retail shopping. Another thing that was I looked at that the other analysts all were about 9% also, and usually BetterInvesting is a little bit more conservative. So I thought, I agreed that the 8.5 is a better number as far as a forecast for the sales going forward. As far as the historical earnings per share, I did look at we did look at the preferred procedure. We did come up with 10.7. And as far as the projected 5-year sales on growth, again, that's 8.5. We really went fairly low with the expenses because of looking at the numbers. As far as the taxes, we've averaged it out to be around 17 instead of the 12.6 that the system put in. There are no dividends, and we went and averaged the outstanding shares as 10,004. I'm sorry, 10,004 instead of the 10,331 that they had. As far as, again, the sales trend, it looks like it's 9.7 for the, it's still too high. And when you're looking at the earnings per share, as far as the growth, we figured a 5-year estimate of $5.39, a 5-year estimate of $5.39. So that was what was chosen on that. The debt is going down. Their return on equity is up. The numbers are very, very off and difficult. You know, pre-tax profit on sales is going up. The numbers, the PEs are the highest PEs I've ever seen, and the price is going up consistently, the high price and the low price, and as is the earnings per share. But the PE, the current high PE is at with that, once I took out the outliers, is 156.7, or is that 150? Yep, 156.7. And the low PE is 74.7 is what the system gave. Looking at the PE as far as the low PE, I'm sorry, the high PE, we figured that it would go, we did look at the numbers. Some of the numbers just had it too far out of the park. It's just such difficult numbers to work with. So we went with 30, the average high PE of 30, forecasting 30, which works good. Now, this is based on the closing price of that Friday evening. The low price, we agreed on 20% of the closing price, 20% of the 95, 27 is 76. So we have 76 as a forecasted low price. It is in a buy range. It's in, on the borderline, not quite border of the buy range. And again, depending on the numbers you choose, it could easily go into a hold. The total return is at 11.2. It has no dividends. I think I mentioned that earlier. And it's the many people, some of the analysts that when we went over it together, the analysts that were on the call are feeling that it may, the price may go down some, and I agree. Yet the price is going up, and right now people are buying, and I think they're looking for something to buy. This is a low price, and it's a company that people are familiar with. And you think Amazon's going to do something. Amazon is looking into going into medical care of some sort. That is something that's new on their horizon. And so it's a 3.4 to 1 on the upside downside ratio. And it's a buy, but it's a questionable buy. It's a buy with caution.
think the other thing we discussed was, how just the and Reddy, maybe you can answer this, but the ratio of large and mega cap companies that we have in the portfolio versus the small and mid-size. And then not having any one company more than 5%. I think Amazon is less than 5%, but we would be trying to get more small and medium-sized companies.
I have a couple of different questions, Henny. Thank you.
So Reddy, feel free to ask any of the other team members. I don't want to monopolize the conversation. So.
No, Henny, you have the very high knowledge on this one. Okay, I have a couple of questions to Anitra. First of all, I have a very, very basic question, not being a financial guy. The whole SSG methodology is based on study companies that have been in business for several years. Amazon is a ever growing company, ever evolving company.
Yeah.
How can we project future based on last year and this year data? Hardly. And if you, especially you discarded last several years.
Yeah. What?
That's a good question. One of the things I initially thought to do was leave them all in there, because and the only reason why I thought of that is because all the years is because Amazon is changing so much, and that the formal years, that going back to 2012, would pretty much average out the fact that Amazon is not going to be able to go forth as strongly as it is. But if you look at the numbers with the, especially with the earnings per share, it's a negative 8.5. That's not something I was ever familiar with. So when we went over it as a group and decided, to take those numbers out, it's something that's different. It was a change, but this is a challenging company. It's a company that has no competitors, no true competitors. You have to section it off to find out who their peers are. There are so many different companies that are recommended, but are they true peers for Amazon? So that I get.
Okay, I know you're all worried about peers, but this is an ever evolving company. Even
Reddy,
as today.
Reddy, to answer your question a different way, if you look at 2021, the historical sales are say $470 billion, right? So if you grow that at 21%, that's an extra, say, $100 billion that you would have to grow at that rate over, So is that possible? Maybe, but if you want to be conservative, and we were very conservative and we're still in the buy zone. So I think, just the law of large numbers, if you have that kind of revenue, it's difficult to grow it at 20%.
Yeah, it's difficult to grow. It's a different company. They have no single one product that we can judge, base our judgments on. It's a totally different company, Henny.
Well, everyone has their own opinion. That's what we came up with.
Yeah. Yeah.
Yeah. Okay. What interests me is we cannot judge the company based on discard everything before 2 years data and project further.
Okay, but Reddy, you quoted, you cited these negative numbers back on 2014 and maybe a little bit earlier, but
Jay,
Yeah,
I'm
historical
not
earnings per share.
the logarithms do not have any definition of a negative number. So anytime you see all these numbers,
Yeah.
negative numbers, you
Yeah.
just discard them.
Okay, but you see, these occurred many years ago. The most likely trend to continue are the most recent trends. These trends happened many years ago, so you can almost discard them. Almost keep an eye on them, right?
Yes.
The most recent trends are these last 2 years. Now we had, we came out of a bubble. The stock market, or the S&P 500 PE, I think Haney was saying the other last time, was like 19. Well, historically, the average is 16. So we were in a bubble. Money was free. Everybody was borrowing money and they were just piling it into, and sales were high and everything was great and wonderful because money was free. Now it's different. Now it's all changed.
Yeah.
So, now we projected for the annual.
I personally judge these things when you see a negative numbers, replace with a small, tiny negative, positive number, like 0.01011, okay?
Yeah.
Just to see the trend of the graph.
Yeah.
Because negative numbers do not have any definition for logarithms. This is a logarithm plot.
Yeah, but look at the trend. Look at the last trend. It just dropped, almost like a rock.
Yes.
Amazon is not going to drop like a rock. So we had to take away the projecting from the quarter, projected from the annual, the trend. Right?
But I'm not ready. I'm not sure about, you keep referring to negative numbers and logs, but we were talking about sales, and there are no negative numbers in the sales.
Yes.
Right. So that trend is fine. All we're saying is that if you take out all those red sales figures, right, you're going to get about a growth rate of 26% over the past 10 years.
I absolutely agree with you, Haney. All the positive numbers should be kept as is to get the real feel of the trend.
We did. We looked at it and said it was 26% for 10 years. And we thought that was a bit aggressive going forward. Given that we're going into a recession, we wanted to be conservative. And we put in an 8% growth rate. And then we worked out the preferred procedure and came out with a 3.4 to 1 buy. Initially, we were going to put a 40 high PE. Then we said, well, that might be a bit too aggressive in this kind of environment. We went with 30 and it was still a buy. So I'm not sure what the point is.
Yeah,
okay, we're just debating, now about what to look at on the SSG. There's no questions that I hear right now. So if anyone has any questions, we probably should move on actually to our guests to ask them what they thought of the meeting and everything. But if there's any questions, we could take a question or two. But
I have a question for Ron. When they do 5, 3, 2, 1, should they look at annual or should they look at the quarter?
It depends what you're focusing on. We normally do an annual, but if you have to give your quarterly report, then you go to the quarterly. But I just want to go back to this Amazon for a second. You guys are making your projection from the annual. What happened? Do the numbers change when you make your projection from the quarterly? Take a look at that because it has to grow its earnings from its quarterly now, not from what it has been. And that's going to give you a completely different prospect, because if you put that arrow on that last quarterly, how much are the earnings per share then? See, $1.81 instead of the $3. You see that? And so if you go 30 times $1.81, you're only going to come up with like a $48 or $50 stock.
No, that's true. We actually went through that exercise, Ron, and because it had dropped so much, we took it from the annual, but we had that discussion. That's a good point. And we were also looking at the value line, and the value line had a number that was much higher than $1.81. So we kind of settled on going from the annual and then using the preferred procedure, and it came out to the $5.
Okay, so to go back to the question
Ron,
of
Ron,
go back to the question of Jane.
Ron,
Yeah, 1 second. Let me finish her question for a second, her answer. So now that you're doing the quarterly, when you do your 5, 3, 2, do it on the quarterly.
They did, I
Right.
think. That was
Okay.
my question. They
Yeah.
did a quarter, but the SSG was annual. So now you select the quarter. Can we look the page 2, valuation and return? What does that look like?
Just
Oh,
but
yeah, you need to fix
yeah.
that. Yeah.
Yeah.
Because the
So this
yeah.
is how I would make my projection. Okay, you know that all the other departments that Amazon has does not make any money at all. The only department that makes money is the AWS. So I would like to find out. This is what I would do. How much is that growth ratio from AWS? And then I would subtract all the other departments that don't make any money and subtract that from the growth ratio. And that tells
Actually,
me a more precise number of exactly how much it can grow.
actually,
Okay, because
AWS was what to your point was starting to slow down considerably, and the other two competitors were growing at a much faster rate. So actually, the growth went down a bit if you look at the trend for AWS in particular.
right, and so how much is that going down? And that's what I would take under consideration when I make my growth projection. So if they're growing at $1 per share, but it's costing them 80 cents to keep the other non-profitable departments running, then I would only grow at 20%. And so I would make my projection at 20% instead of 100%. That's just a metaphor that I'm using. And so that gives me a better understanding of where the growth is actually coming from. So it's not coming from the other departments, but it's coming actually from the advertising, which is actually coming from their AWS. And how much is that growing? And you just told me it's going down. How much is going to go down into the future, right? And then I start deducting things. That gives me, and it's all guesswork because nobody knows who's correct. And you come 5 years from now, and you say, okay, this was the right number. But at least you're more in the ballpark. You're more rational, and you're more logical when you do it that way.
That makes sense.
Well, well, Ron, if we start from the quarterly, and because it's down so much, in order to get back to kind of a normal level, we have to assume a growth rate of huge numbers.
Correct. And so what happens when you look at this stock, okay, because
Yeah.
a lot of people just look at the price, right? Now,
Yeah.
they have a big mountain ahead of them. And it's a very slippery slope with Amazon, right? It's hit or miss now because you're dealing with billions of dollars. And
Yeah.
so when you were doing the 532 and you were doing your net free cash flow for every $100 for the sales, and ILA showed that, they're only making $7 worth of net profit. $7 out of 100.
Yeah.
Okay.
Not very
You take a
powerful.
company like Lockheed Martin, for every $100 worth of sale. Look at Lockheed Martin. Their earnings is $23 per share, and they're paying out $13 per share just in dividends.
Yeah.
Amazon doesn't even make $13 per share in paying out dividends. They don't
Okay.
even have earnings of 23%. You see what I'm saying?
Well, on top of that, you have a PE ratio of 87.
Yeah.
When the market is going down to about 16 or 17 right now. So
Correct.
what are you paying for when you're paying 87 times versus a market of 16 or 17?
Yeah.
Correct. What do you base that on? You know, so to me, I own the stock, okay? Because when I gave that presentation of Amazon, what is it, in November or October, and it was going for like 120. I said I will probably nibble at it when it hits in the 80s, which I did. And I still thought I overpaid because I think it's only worth $60. But what I'm betting on is AWS. It is a rock of Gibraltar. Everything else, Amazon can just throw away. It's useless, except for the advertising right now, right? And the subscription of the Prime that they got, because that is what SAS, you know, subscription that they automatically get their money every year, and they just increased it by $20. So people are not going to drop out, at least in the United States. I don't know about Canada. So they do have some strong.
I think I worked that out to about an extra $4 billion a year. That $20 subscription.
But are they good capital allocators? So they're going to lay off what, 20%? So now they're cutting back.
Okay, thank you,
We're
Ron.
hitting a recession. They had supply chain problems, right? And they have new CEO.
John, I have a request for you. If
Go
you
ahead.
can, if you can you try to make up a presentation for different projection rates like annual, quarter, and trend line, because they have a significant bearing on how we project, and most of the people not familiar with it. Especially,
You know what? The projections is kind of like based on an individual basis, because if you take 5 analysts, you come up with 5 different projections. And it's just what you focus on to come with the numbers, right?
yeah, but for the companies which the current year have a downtrend, it makes a big difference between annual projection, quarterly projection, and trend line projection. What are the differences, and where we should pay attention?
Ready? I have to interrupt you. We only have 12 more minutes, and then we need to get to our guests. So,
okay, you rule. Okay.
Okay. Mina, I don't know. Are you online, Mina?
His microphone's not working.
His microphone's not working. So, John,
Yeah.
do you want to go through and thank you very much, Hanny. That was and the team, Isla, Anitra, Joel, Christopher.
Thanks everyone.
Yeah, excellent presentation. So let's go to the guests now. I'll unmute them and you can, and if they have any questions or comments.
Okay. John, thank you for attending the meeting. Do you have any questions or comments?
You're self-muted, John.
He has a few, a lot of questions. Do we address his question?
Okay, John, you're self-muted if you want to.
If you want to click the orange button, I think it looks like for you.
Well, he's got.
Unmute.
I can.
We can move on to Lori. If you want to unmute Lori, unmute yourself. I can ask you the same question. What did you think of the meeting? And thank you for attending. Lori, can you unmute? Are you able to see the button to unmute?
If you don't have a working microphone, you can just type in the comment in the what do you call it, chat. Just let us know.
Sure, in the chat, correct. Yeah. But if not, Richard, you are also self-muted at this time. But thank you for attending the meeting. If you would like to make any comments, feel free at this time.
I do have some questions from John. He said, great presentation. Is there any internet site that gives these same type Excel information the way you just did? Hanny, is there any website that gives that same type of Excel information?
The Excel, you mean the financials? We got those. You can get them from different sources like Yahoo Finance. If you have iClub, it's available on iClub. You can get them from Morningstar, but you have to make a lot of adjustment. So there's a number of different sites.
Oh, you're fading out, Hanny. We can't hear you.
Sorry, can you hear me now?
Yeah.
Yeah. So any like you're talking about the 10 years worth of financial data, is that?
Well, he said, is there any internet site that gives the same type Excel information the way you just did? So it must have been like when everybody was going over their sections of the
Well, we
I guess
put those together. We got the 10 years of data and then just put it in Excel. But Morningstar has some of the ratios. You can use Morningstar as well.
okay. And then he said, how can you have a high PE of 30 when it is now 87? Even the low PE has never been lower than 30.
So if all of these high PEs were based on the last 10 years of free money. When you do a discounted cash flow at whatever the interest rate is now, 6% or whatever, the value of this company will drop like a rock. So people are going by PEs that are historical, that are based on different economic conditions that occurred in the past 10 years, which will not occur again, as you know, probably after I die. I don't think we're going to see interest rates at 1% anymore anytime soon. And that impacts the valuation. So these PEs are all, I don't look at the PEs, you know, from the past 10 years. You have to start getting, you know, more reasonable valuations.
Okay, and then one more question. I think that you should use at least 5 years of data, not 2. Is there a response to that?
Again, we were just looking at sort of the last, if you look, I don't have the SSG in front of me, but if you did 5 years, I'm not sure what the growth rate is. It doesn't really matter what the data is. We were just trying to project the growth rate, and so you know, if you look at, okay, it's 27%. I don't believe that Amazon is going to grow at 27%.
No.
Right, going forward. So we picked 8. The analysts had 9. I'm still doubtful about 8%, but you know, again, like you can do 27. It's subjective, right? So it's just whatever you're comfortable with. I personally would not be comfortable with 27%, whether I use 5 years or 2 years or whatever. I have to come up with a forecasted growth rate, and I think, you know, 8 is on the edge of high, in my opinion. But
Can you hear me now?
Yes, hi, John.
Yes,
Wonderful.
John.
Thank you. I don't, if I could just interject a little bit. Number one, I love all of the presentations. I think you guys are a very professional group. But from the SSG presentation, I'm not arguing about the numbers. I'm arguing the point. I think it's unwise to block out more than 5 years. So instead of looking at 2 years, which you were looking at, I think you should have been looking at least 5 years. So I don't care what the other numbers say, but as a principle, that's what I use.
we actually looked at 10 years, and then we looked at, you know, we went back and said, okay, 9, 8, 7, 6, and so on, and just trying to see what the growth rate percentage is over those years, right? So if you look at 5 years, it says the growth rate, the average annual growth rate over the last 5 years has been 27.7%.
Yeah, I don't think you made a mistake at all.
So historically, we don't look at like just 2 years. That's just in this particular case because
yeah,
the company is so large and the growth rate is so large that it's highly, you know, improbable that they're going to grow at 27%.
I guess in that, for that reasoning, it's probably okay.
But
So
yeah, I mean, I agree with you. We don't hit, like, typically we don't block out, you know, 8 years and just look at the last 2. But
yeah,
it was just in this particular case because the numbers are so big.
sure. Thank you. I appreciate it, and I appreciate listening in on you nice folks.
Thank you, John. And Lori gave a comment, great presentation. Let's see, what did she say? Thank you. Thank you, Lori. Okay. All right, so I guess we're got 4 minutes. Club
I want to
business.
touch base, if we have time, Joanne, to about next month.
Yes.
I don't know if Mina can talk right now, but with his microphone, but I think he's being the lead for next month's stock study. And I think I'd like to join as well as a second member.
Oh, Anitra, we'd like to invite you too to do kind of a bona fide stock study. I think this was kind of an exception for this Amazon review. So would you like to join for next month, Anitra?
Okay.
Oh, that'd be great. So I would also like to be part of that, and I'll be your mentor, Anitra.
Okay. What stock? On what stock?
Oh, so what we're going to probably do, I don't know, Mina's not online, is we'll probably go through. So one of our objectives for the executive team just met is to optimize and maintain our portfolio strategy. So what we try to do is keep one stock per member. And I don't know, John, do we have one stock per member now? Or
Yes, I believe we do, yeah. Well,
okay.
got Disney for now.
So what we do is we look at our portfolio and see if we can challenge any of the stocks in the portfolio. So what we like to do is replace with a better performing stock. So we'll go through like a portfolio review, and then we'll look at.
I'd like to.
Anitra wanted to join, potentially.
Okay, first Hanny and then John.
I was just going to say I'd like to replace Amazon.
Okay.
Yes.
Okay.
Okay, and John,
go ahead.
That's interesting.
I was going to say we don't necessarily need to review and replace. We could add a stock if Anitra chooses to join, right?
Okay.
We'll have to let her make a decision after the meeting.
We decide.
She can make a decision either tonight or after next stock study.
Sure. Sounds good. Okay. Piero and Megumi, you're doing annual reports most likely next month. You think you are, right?
Next month for Amazon, right?
Yeah, Amazon.
Yeah. So yeah, Amazon is just it's essentially already done. So I will do that next month.
Well, you'll have new quarterly data. Well, you have your. Yeah.
All right. So maybe we can. I don't know if we want to sell now or sell then, but Megumi, you're good on Meta. It's going to be an annual report usually by February. You'll be ready by then. I have you down for that. I'm just going with what was last year's schedule. So
I also want to have a comment about Anitra, the way that we want to optimize my portfolio, just as much as just like we do our own portfolio. We need to take the same approach for our own portfolio. How to review, how to replace, add on, all that. So it's just a process how we do things.
Thank you for sharing that. I want to say that I really appreciated working with the team on Amazon because it was such an unusual stock as far as what I've seen with Better Investing for the time I've been a member. And even blocking out the 8 years, it's all about education and learning. And I found that I don't know how I would have, everybody's playing with numbers sometimes to try to get something. Some people try to get a mean that the end result that they are looking for. But I think that they were very sincere about coming up with something to deal with the fact of Amazon numbers going down, but yet having so many different products. So I just thought it was really interesting and educational, even though there are, questions about how it was done. But I think I enjoyed it. And so, but yeah, I did.
Were you in a different clubs before, or you always independent?
No, actually, no. I am in a club.
Oh,
I
you are in the
just
club.
started. Yeah, it's the newest club in Better Investing, and it's only been around going on. They're going on their third year, but I would be going into the second year with them. And
Okay.
it's interesting. It's different than yours. What the thing it's different because it's new. Even not everybody in the club is new, but even the person that's running the club is her first time doing it, and she's doing a good job. But it's just a different format, and so yeah.
Hmm. We do have a members belong to multiple clubs, even in our club as well. Yeah, you're welcome to join us if you feel like this is the right fit for you as far as learning, you know. Um, so there's no any additional cost to you except the club member fee once a year. There's so little, like a few dollars breakdown because we divide it by a number of club members. So other
Okay.
than that, there's no additional cost for you to join. Only if you feel like this club can provide you something and you can contribute, like it is a right fit for you. I don't want you
Actually,
to
I
feel
think you.
obligated.
No, I appreciate that. I think you guys are great because I even talked to her about it. I told her I thought you guys really have a very good dynamic. You I was trying to explain to my mother about it the other day, and she said, I say they challenge each other. She said, "You mean like on The View?" And I said, "Yeah, kind of like on The View, But you're challenging each other's ideas. You're thinking it through. It's like being in a think tank and coming up with ideas to make it work. And that's why this, doing the 8 years was different, but I get it, and I'm like, okay, I never would have tried it, never saw anyone else try it, but it makes sense. And Hanny does such a wonderful job of giving of himself to help make things happen. His giving of his intellect, his time. I see that. And I just
Mhm.
think you guys are a great group because you're going to always offer ideas that a lot of other clubs just going by the book. You guys are challenging, and then other people challenge too. I hear a lot of people saying, better investing might have to rethink. This things are changing. The way that everything used to be, especially with the market being how it is right now. But
Mhm.
you guys will challenge something, and I like that. So yeah.
Hey, we would love to
But
have
I
you.
do want to. I would like to sit in on the other one because I'm feel like I just bumbled. I'm like a nervous wreck.
Oh,
Well, you did awesome.
yes,
You did great, yeah.
you did a great.
Well,
Yeah.
last piece of
I
business on my
tried.
part is I'm gonna add people's names based on the last time you did an education topic. I'm gonna add your name to the calendar thing, the spreadsheet we have for that. And I'm gonna leave some spaces for some guests, but I'm gonna add most of our names on there, and I'll email everyone once I do that with what the list is, But feel free to come up with a topic before that, like a month or so before that month,
Okay.
and
Okay.
that's what I'm gonna do though.
I have a last thing for the members, for our club members. We are inviting Avi for our education topic for visiting us next month, only if he's available next month. He told us that he would love to visit us. We can give him an education topic. Are there anything when we are interested that we want him to present? Let's think about it. You can also email me. I can send out an email after the meeting. Think about what would you like to hear from Avi during his visit. Okay.
Okay, so maybe we should stop the recording now, unless there's someone else with some business.
Oh, I'm sure Ron has a lot to say. Ron has to address the why we choose 5321.
I'm unmuted. All right. The only thing I want to say about a 532 is that when you take a look at the cash flow statement, you just go over every line, and if something really sticks out to you out of the ordinary, but it makes an impact, that's the one you're going to concentrate on. So you have all these line items in there, and all you got to do is just pick 5 of them. that you think are a tipping point for the company or for that quarter. Okay, that's why when they do the 532, you have that option of what you want to pick. Just stay with that. If you do the cash flow, just stay on the cash flow statement, right? Now, when you have that net income that comes in from the top, from the income statement, and then you got your net cash from operations on the bottom, you want to always make sure that the net cash from operations on that bottom line is always higher than the net income from the income statement. Okay, that's the thing I want to point out to you guys. But for the rest, it's just like whatever catches your eyes on every line item that you look at. And if some of these things are really hitting you with a 2x4, then say, hey, I need to check this out. So there's no
Ron,
set agenda.
could you please repeat what you said about the income? I missed that.
Okay, so you know when you get your net income on the bottom of the income statement,
Yes.
that gets carried over. That's the first line on the top in your cash flow statement.
Yes.
Right. And then you go up there and you got all your that you add on and that you subtract, and then you get into your net operating cash flow on that thing. Okay, that item right there, that number should always be higher than the net income.
Okay.
Okay, because you're adding depreciation in there, right? You're adding things in there that are not actually monetarily put in, right? And then another thing that you want to do is when you take a look at the balance. And another item I want to point out to the cash flow statement, because I think the cash flow statement is so important. When you have that net operating income, that first section, and then you have your financing, right? That you have up there, that's the next section, right?
Yep.
And then so you take those other two sections that are underneath the net income, you take those two numbers, the total two numbers on those, and then you add those two up, and you want to make sure that that is always less than the net income, than the net operating income. So can you pull up a cash flow statement here on the screen?
I have one.
Okay, pull it up, and I'm going to show you something that I think is very important. And then I'm going to show you another.
So Ron, cash from investing and cash from finance together should be less than cash ops.
No, yeah, correct. So here you got a number, right? Cash from operations, right?
Right, cash from operations.
Right, so fiscal year cash from operations is, I don't know what company this is because there's a minus, but it's a 46. You see that right there? All the way, go to the right, all the way to the right. It says 46 million or 327 or 46 billion 327, whatever this chart is made
Amazon.
of. It's Amazon. Okay, so when you take a look at the investing activities, and you take a look from the cash from financing.
Cash from investing, cash from financing.
Okay, so if you got the 58,
oh yeah,
right?
That's
and then you got your total cash, which is 6. So if you subtract that, that's 52, right?
Right.
Okay, so then take a look. Take a look at your cash from operations. It's 46. Way over, right? You want it to be less.
Right.
Okay, that's another item you want to take a look at. That's very, very important. So if you want to take a look at a cash flow statement and you only have 30 seconds to look at it, find out how much money is coming in from the cash flow from operations, and then take the other two from financing activities and investing activities, add those two up, subtract that or add that to the cash from operations, and you should be in a positive. Now, the net income on the top is the 33, right? So your cash flow from operations, should always be higher than the 33. So 46 and 33, that's good. It's just that they're spending more money. You see, they're spending more than what's coming in. And that showed on the 532.
Right.
And so that's very important. So it automatically hits you. And how much more did they spend? Okay, now if they spend it into the future and it's a one-shot deal, that's okay. So if you go take a look, for instance, at the previous years, then you can see that this year it's an outlier. You see that? So for instance, take a look at that. Go 2 columns back and you see it's 38,000. You see that 38.5? Yeah. So here you got 24 and 10. That's 34, right? And so guess what happens? they're ahead of the game. So that's healthy. So is
Now,
this
why
just a
is cash?
one
Why
type
is
of thing?
cash from investing negative?
Where is cash from investing negative? Because that's money that they invest in their capital expenditures and the technology into their
Oh,
plants,
okay.
their equipment,
Okay.
property, buildings, things that they acquire. So it's
Right.
all the physical assets. So that gets subtracted, and so the cash from operations can support that because
Right.
it's internal growth, right? Because they still have the money to pay for that. And then you take a look at the next one on the financing. And so if you add the 24 to 10, that's 34, but there's 38 coming back. So you got a $4 free cash flow that comes in. Okay, so that's good. Okay, and then you look at the bottom line for free cash flow, and is the free cash flow growing? And look at that, it was 6 billion, 9 billion, 6 billion, 17 billion. It's all the way on the bottom, second one from the bottom, 21, 25, and then a minus 14. And then what you want to take a look at also is you want to take a look at the income statement. So you said earlier that they bought back a lot of stock, right? But how much did they pay out in options? So did the stock count go up or did it go down when you take a look at the income statement? Here's the income statement, and then
Yeah.
you take a look at the average basic shares outstanding, right? And look at that,
Right.
it went up.
Yeah.
You see that? So even though they're buying back $6 billion worth of stock, but there's so many stock options out there that, and this is hurting the shareholder because actually he's getting a smaller piece of the pie, even though they're buying back the stock. So when companies say, I'm buying back my stock, then you say to yourself, every time you look at these financial statements, you got to say to yourself, how is this going to benefit me as a shareholder? And that's only when they buy back stock and the share count goes down. See, people don't look at the second step. Are the dividends going up? Is the free cash flow going up? So by looking at those three financial statements and you do the 532, you can actually tear the gut of that engine apart.
Yeah,
But it
because
takes practice because after a while, you know what to look at, you see.
their stock-based compensation did go up, and then they bought back, but not that much. So it was, when I looked at it, it was less than last year, but it was still quite a bit of stock-based compensation. So
yeah, and why do they do that? Because they pay their engineers. Because all these companies, if you go back and you look at their income statement and you look at the administrative, is this the income statement that you got up here?
this is the income statement. Yeah.
Okay, bring it all the way to the left. I want to show you something, and I want to look at when it shows something up here. So they got discontinued operations on marketing and administrative costs, SG&A. Then you can see, let me see, they don't have that up here. They didn't break that down. If you look at another company, for instance, you can see that they spend a lot in the SG&A, and that's because they're hiring a lot of engineers.
Yeah.
Okay, so it doesn't show anywhere else in the financial statements. That's why you have to look at the SG&A. Your
Like you could look at the
administrative,
notes, the notes.
general expensive, and your administrative, that type of thing, right there. Administrative expensive. Look at that, how it's going up. You see where it says administrative expenses?
Yeah.
And follow that line and look how it goes up because they're all paying their engineers because this is their IT people.
Yeah.
Because they're on the internet, because this is actually an internet company and they're doing with some merchandise, but basically their bread and butter is AWS. So when you see that number going up, you say, why is that going up? Why is the administrative expenses going up? Well, that's because they're hiring all those engineers. And the reason they do that, because that's what they did, they overstaffed themselves, because if they don't do it, then Google and the metaverse and all these other people are going to buy these engineers. So
Right.
that's where the value is of that company, right? And that's where you get the goodwill, right? Because people was asking, what's capital expenditures? Well, capital expenditures that they spent earlier, this is another question, It's actually the funds that are used to upgrade and acquire the technology, the physical assets, the property, the plants, the buildings, because the company has to keep on going. And then you also have to look at the maintenance expense. How much does it cost to keep this thing running? So there's two of them. So you got to read the annual report or the 10K. There's a lot to it, but you guys are on the right step, you know. So
it takes a long time before your eyes get used to, you know.
Yeah. But now you at least you know what to look at, right? You look at the 532, which is excellent. And once you got that down pat, matter of fact, I don't know if Jane told you this, but she's in a special focus group with me and Bakul and two other people. And we did another group, and we keep another company, and we do 532s on them. And then even though we are pretty good at it, we throw it to Bakul, and Bakul still shoots holes in it, and so this cup doesn't hold water. But you know what? You always learn, right? You always learn.
Yeah.
And that's what it's all about. Like Anitra said, I'm here to learn, you know, and you never finish learning. This is the hill I'm going to die on. I'm going to learn as much as I can. And sometimes I'm right and sometimes I'm wrong. I'm going to let you guys go because it's already late for the people back east. So
thank you very much, Ron.
Thank you for inviting me.
Thanks for your time.
All right. Bye now.